Okay, good afternoon, everybody. Today is November 5th. This is the weekly take on the market. I will be your host. I'm the product group manager for premium product groups here at Investors Business Daily. My name is Scott St. Clair. Here is a quick disclaimer. We will talk about stocks. Take a moment to read this. I'm not licensed to give advice. Really want to help you to learn to do this on your own. So the gauges, the market is fine. It just goes up almost every day, it seems. We'll look at that. The leadership is, there's leading stocks for sure. It's, you just can't argue with that. There might not be a ton of leadership, but I think there's enough leadership, and we'll look at some of those. And then hopefully your portfolio was green. If it wasn't, that doesn't mean you're doing it wrong. Maybe you've been sitting in some stocks that you have big gains in and you're trying to let them work and they're going sideways. Or if you're red, maybe you need to, maybe I'm out of touch, I'm not in the right areas, etc. We are kind of in the middle of earnings season, so that could throw a wrench. There's been some nasty surprises and some good ones to the upside. Luckily, the nasty surprises have been in stocks that didn't look good. So hopefully most of you weren't in those. And the upside surprises were in ones that were, the stocks were holding up, which is how I'm glad it is that way versus they look really good and then they break bad. That's the worst case scenario for earnings season. So let's look at the markets. I found this chart on Twitter, I believe. Bespoke Invest is their handle, and it's streaks where the S&P is up 15% or more. I lived through the first streak from 1995 to 1999. I think it was 4 years in a row where the S&P was up 15% or more, back to back to back to back. And then currently, as we sit here now, I think we're on year 3 or year 4. I don't remember exactly, but this chart's rather ominous. You can see some of the previous spikes led to mini bear markets, not including the the 30s. But after 99, it was a lot tougher for sure. I don't know what this there are the number of years on the side. You think I'd have read the chart, right? So 5 years in a row for 99. That means the S&P must have been up 96, 97, 98, 99, 95 as well. And actually, I started in the business in March of 1995. Well, I opened my first account in March of 95. I started much sooner, but I didn't have any money. So that was what a fortuitous time to be a growth stock trader. And now as we sit here, 3 years, it's nice to see these little charts. I don't know what it means, but I'm always, thinking outside the box, because sometimes the market surprises me and then I say, it shouldn't surprise me. Like, when stocks do crazy things or markets do crazy things, I'm just kind of over being surprised by what markets can do. Oil can go negative. Tesla can go up 50-fold. Nvidia is up, 50-fold as well from its lows. Anything can happen in the stock market. So you have to be open-minded to all of the possibilities, but it is a game of probabilities. So you have to understand the probabilities based on history of the market having another great year are lower than normal, I guess would be the best way to put it. Doesn't mean there's zero, but it's not 50-50. If you allowed me to make a bet, yes or no, which way, then it'd be easy to, you'd want to bet no, but I don't have to. I can go with it and see how it plays itself out. But bottom line is the market's been really, really strong for the last few years. You've had some corrections. I think the Christmas Eve massacre in 18, it was short-lived, and then the initial COVID crisis was very short-lived. But they were nasty. If you were in those, you would have felt a lot of pain. But they were short-lived. So you were able to survive, and the market comes back pretty fast. So let's look at the indexes. Here is the NASDAQ. So we're at what, 2, 3, 4, 5, about 9 days in a row. It's very unusual. Let's look at the weekly chart. I mean, we're just in an uptrend. And I even looked at the monthly chart because I was trying to figure out how stretched the market was. And I've got a simple moving average of 50 months on here. I've got a 10-month moving average, and I've got a 50-month moving average. And we are 64% above that. And if you go back and look, since way back when, the market's never been that stretched above the moving average, except way in here. And I would have to change the chart. Let's see if I price scale best fit. This is the 1990s bull market that you saw on that chart. And there's March of 1995. So don't confuse brains with a bull market. Sometimes it's nice to have the wind at your back, but you can see the market was super stretched above the 50-month moving average, 93%, 128%, 114%. Very, very unusual, and never since have we been this stretched. So can it be more stretched? Sure, but based on history, when they say the market's extended, it's such a blanket statement. Like, okay, what's the number? What's it extended from? And so it's not a perfect indicator, but I guess if you're looking for something, you just use a moving average, and then you can tell yourself, okay, it's based on history. Yeah, this is unusual how much above the 50-month moving average the NASDAQ is. Let's look at the S&P. So it's 45%, but you can see back in the 90s, 45% was the norm for months and months and months and months. So maybe we're in something like that. Maybe we're right here, or right here, or right here, or right here. I don't know. I don't know. I think it's a little stretched as we sit here. I'm not fully invested for that sake, but also it's, the market's not coming in at all. And one thing I think Mark Minervini said on one of his interviews I watched on YouTube, and I've been saying it for years. And it's not that he took it from me, believe me. No, I probably took it from him just subconsciously. Maybe he said it years ago and I heard him say it and don't remember where I got it. But when you're in the leading stocks, where you're in these quality stocks that you can identify, you don't need to be 100% or 150% or 200% margin to outperform. Tesla, Nvidia, and we'll go through some of these. If you can be 40, 60, 80% invested and be in line or better than the market when you're in the leading stocks. So keep that in mind. If you're not fully invested, that's okay. You don't have to always be fully invested. It's the one advantage you have if you're running your own money, is you can be 80%, you can be 60%, you can be 10%, or you can be 200%. And the institutions are almost always like 97.9%. It's like ridiculous. The number, if you look at a mutual fund, their cash, it's very, very, very tiny. So use that to your advantage. So S&P, let's go to the daily. Looks fine. Is it extended a little bit? Maybe, but we're in an uptrend, bottom line. IWM, I made fun of it for so long. It finally said, hold my beer, broke out of this really big base. It's a pretty good breakout. Looks very constructive. I don't know if it's going to go on to something like that, or run like that, but maybe it could go on a run like this. That wasn't super long, but it was, went up, built another base, went up. But that, very good, I think, for the market. Allegedly, the relative strength is a disaster versus the S&P. It's been such a laggard. So it's just, I just find very little merchandise in this index. But food for thought, if you trade ETFs, if you like to have some overall market exposure, maybe this could be a place to have exposure for a short while. All right, let's go to the industry groups. Open Stock Ideas weekly review, 197 industry groups. The first time you do this, you're going to be in alphabetical order. You want to click this column header right here called Industry Group Rank. That's going to resort this list. Now it resorts based on the largest number. So the largest number in this case is the worst group. Normally you'd want, if you're sorting by composite rating or EPS or something, or you want the largest number on top. But for the group strength, it's the opposite. So let's go ahead and click it again to resort. And energy coal is still number one, even though some of those stocks have got hit pretty hard off the highs. Retail department stores is 2. Electronic semiconductor, fabless is 3. Oil and gas, finance, consumer loans, that's Upstart. Auto manufacturers, there's a newbie. That's, who, Tesla. You can see 3 months ago is 173 while Tesla was building that really big base. Last week it was 10, currently it's 6. Computer software, security, Zscaler, CrowdStrike, that's that group hanging in there. Energy, solar, moving up the food chain, 167 3 months ago. Last week was 13, currently it's 8. Enphase broke out of a double bottom on earnings last week, I think, sometime like that. Then you got computer. So you're getting some more growthier type groups in here. I think last time I did this was 2 weeks ago, was just packed with oil and gas. So there's lots of possibilities. Upstart, Tesla, NVIDIA, and even in oil and gas, EOG seems to be acting really good. Some of the others. So it's nice you can be kind of diversified in different types of groups. You don't have to have software, database, networking, maybe you've got net, computer tech services, that's something like TaskUs, ServiceNow, stuff like that. And it's all, technology, which is, you feel like you're diversified because you have, 8 different stocks, but they're all in the same sector. And that's kind of what this how we group it. The first name is the sector. The next name is the industry group. So computer is the very broad sector, industry group, software database. Computer is the very broad sector, industry group is networking. If you're unfamiliar with how we do that. Stocks to watch. We'll talk about a couple of them. And then we'll go to the quote of the week. So I want to talk a little bit about like NVIDIA and maybe Tesla and go over some previous examples. Selling is very difficult. It's the hardest thing to do by like 5-fold, maybe more, but I'm going to go with a minimum of 5-fold. It's so hard to sell. And I've sold so many stocks in my career that have gone up so much, but I've also sold so many stocks in my career that don't exist anymore. They just go away or they just kind of fizzle out and do nothing for decades. It's just so hard to know. In hindsight, it seems so easy. Oh, Apple, of course, Apple is Apple. And it's just in real time, it's just really hard to do. So you want to really try to understand kind of your thought process. Are you a trader? Are you an investor? The reason I want to talk about this a little bit is because Charles Harris was on the podcast with Justin and Arusha, and he's been a very, very active trader for his entire career. But he's decided to be like a pit bull on Tesla. He's owned Tesla for at least a year. He's got some really low cost stock, and he's just planning to own that for a long, long time. And so most of the stocks he's trading, but he feels like he has a super special situation with Tesla. And I don't know where he bought it or how, but based on the way he talks about it, I feel like he owns it somewhere, in here. And he's just trying to let it work. So um, maybe that's something that you guys do. I had that screenshot from a previous workshop in the 90s where Bill would say, if I had 4 stocks I was up 25-30% on, I would sell 2 of them. That's a direct quote from Bill in 1992 or something like that. And so you really want to think about it. I don't think you want to be selling all of them. That's kind of the way I've been doing it. And I've thought a lot about this in the last few years because I've sold Facebook way too soon, PayPal way too soon, Square way too soon, and Team way too soon. I mean, I couldn't have got a better entry on Team. I bought Team right there before the gap up on earnings. So it was up 20% the next day as an immediate cushion. And literally, I could just sit with it and own it and own it and own it. But I didn't really know what I owned. That's part of the problem. So, but once in a while, I think you want to try to do this. You really want to try to grab on to one. And maybe it's 1 in 4 stocks that you're up big on, or 1 in 5, or 1 in 6. Or if you don't like to sell, I have some feedback I get from people as they say I'm a terrible seller. So maybe it's you're keeping 3 out of 4. You have the opposite problem, taking profits. But it's this dance you have to do with the market, because I think you want to learn to sell, but the big money is made in the sitting, and it's such a mind cluster to that. All stocks are bad unless they go up, therefore sell them. But the big money's made in the sitting, therefore don't sell them. And when you own them and you get in a profit, it's the hardest thing to do. So I know I've rambled on a little bit. I'm sorry. It's like IBD Live. I've been rambling, but I think it's important. And Charles's podcast, I highly encourage you to watch it or listen to it. But it just made me think more and more about this. I just think about, I really want to do what he's done in Tesla. I really want to grab one and own it. And I've done it almost a couple of times with C Limited. I had C Limit. Is this the COVID? No, I'm sorry. Right there is the COVID, after initial COVID crisis. I had it there, got shaken out on the bad break in the market, and then bought it back there. And there's really, now I look at it, there's no reason I should have sold it. I just sold it because it was up a lot. And sometimes I do that and get rewarded for it. So it's a process. And if you're trying to have big winners, you probably want to think about this a little bit. On the reverse side, I just feel like this is great if you grab these, and they're hard to do, but sometimes what's really, really good is no longer good anymore. So if I look at MRNA on November 27th of 2020, and let's go to a weekly, and that does not look like a stock that needs to be sold. It's going up. And if you bought it there, that would have been really tough. But if you bought it there or bought it there, and you don't like to sell, if you're not selling into strength, you look at that and say, well, why do I need to sell that? It's not doing anything wrong at that very moment. But a lot of times that's the time I will sell them. At least some of them, if not all of it. And eventually it did go higher, and that's the frustrating part. So I'm out at, say, 120, and 2 weeks later it's 160, and you're just shaking your head. You feel silly again. But then it just kind of loses itself, rights itself again. You could have bought it back. I didn't. Now it's at 180, and you think, I'm out at 120. I feel silly, right? But eventually it gets going again, and now you feel really silly, right? But you can always buy it back. I don't know if you'd buy it back there. You might get shaken out there, but maybe you buy it back there, and now it doesn't look like it needs to be sold again, right? It's $300 stock. It's $400 stock. Why do I want to sell that, Scott? And the reason is because eventually they do this. And that's down 52%. And I don't know where you owned it, even if you own it here, which is like the perfect buy point. Let's say you own it at 85. You know, you're still up 100% or more, but you've given back so much that it's really, really difficult to stomach that type of give back. Peloton, you know, is another one. So on 10/16 of 2020, it's going straight up. Why sell it? Well, because it's doing something out of character, right? You can see how it kind of went up in a line like that, and now it's going up like this. And I'm always looking for changing character both ways. If the character is changing really good and it's later in the move, that tells me that maybe I need to sell it. There's a lot of enthusiasm for that name. If the stock's doing nothing and there's a change in character coming out of a big base or something, that's different. That's the start of something. So on 10/16, Peloton doesn't look like a sell, but as you sit here today, and if you sold it, you had to watch it go higher, it went to 160, right? You're out at 120 again, which often happens. But then when you look back, if you were just to see it all the way through, there's very little places you could have bought Peloton and still been pretty happy with your trade. If you paid 30 for it and it's 50, you're up, you know, 60%, but you were up 280% or more. So they always look good at the top. Problem is they often will make more than one top. So, you know, if you're gonna try to hold on to something, you have to ignore some sell signals. Let's look at Zoom. Same thing, like Zoom on 2/12 of this year. No, I want this bar right here. 9/4 of last year. Sorry. Oh, I'm looking at the wrong ticker. 9/4/2020. Okay, so you know, Zoom's just kind of back and forth, stair stepping higher, and then it does this, just kind of out of character. To me, that looks like a sell signal. It looks climactic, knowing that if I sell it there, it's going to go higher. And I can tell you that I sold Zoom that day on the good news. I'm just going to do that. When it just gets that good, and then I'm going to sit back and watch it go higher, almost always. And in this case, if I'm out at 400, I had to watch it go almost to 600. But then as we look at it now, let me reset to today. It's at 264. So this looks like a fantastic sell, and I avoid all this anguish along the way. Maybe the moral of the story is when I want to sell, maybe sell a little bit and then wait, and then sell a little bit and then wait. That's something that I'd like to get better at, because I find that I'm selling them and they're almost always higher a few weeks later. Maybe when I feel that urge to sell them, either don't sell as much, maybe learn to ignore that urge. I don't know. But I'm trying to avoid, you know, this, where you just give back huge gains. And maybe Zoom comes back one day, but it's a long time of dead money. Last one I want to talk about is Zillow. And let's go to, oh, I'm sorry, it's still on Zoom. Come on, Marcus Smith. Here we go. I knew I had the right date. All right, Zillow. Fantastic week. What, doing nothing wrong? Why would you want to sell it there, right? And then you fast forward to now, and that was that. And if you've bought Zillow anywhere in there, you've given back all of the gains. So as we sit here now, NVIDIA looks extended. It looks a lot like it's doing something out of character than from what it normally does. Look how tight it normally trades week by week. Just incremental gains or losses, very little of crazy action. And then you get the upgrade yesterday by, I don't remember which bank. And it just kind of gets extended from, its normal trading action. So that looks very like and unfortunately I don't own Nvidia. If I did, I would be selling into that. Maybe not all of it, but I would definitely be taking some off because it's getting out of character based on, its normal trading action. And then I would expect to be wrong. It'd probably go to 350, but maybe eventually that turns out to be a good sell. So the quote of the week is something that I said on IBD Live, and I don't know how it just took on a life of its own with one of the guys that one of the clients of IBD Live. But and I didn't, I stole the quote from somebody, I can't remember who, but I was listening to a podcast. David Fingold, who's a portfolio manager at Dynamic Funds, I think they're based in Canada, but he said there's an old saying in the business: when the ducks are quacking, feed them. So I was glad to see that somebody else has used that quote before. He didn't know who the quote should be attributed to, but what that means is, I think when they really want your stock, when it's moving abnormally in your favor, you want to feed them. You want to give the market some of your stock that you bought at great prices when nobody was looking, coming out of a base, or when you sat with it and were super patient with it while it kind of stair-stepped higher, and then all of a sudden it just, it's up 35 points in one day on an upgrade. The ducks are quacking. I think you want to feed them a little bit. And Charles talks about that a lot on the podcast with Tesla. So he's never gotten completely out of the position. He has like a core position, and he didn't use this phrase, but basically when the ducks are quacking, he's been feeding them. He'll give up some of his shares. Now he said, all the time, it seems I'm having to buy those shares back at a higher price because the stock's been so strong. That's something you can do, or you just live with it and you got your core position, and it's good. I like to, if I do some selling and the selling is wrong, great, because I still own some of that stock. So you always wish you had full pedal to the metal position, but you have to be realistic with yourself. How are you going to be able to handle the ebbs and flows? And I know I'm not very good at the ebbs. I'm super good at the flows, like everybody, but the ebbs always get me. And so I know that. And so I have to be, feeding the ducks a little bit when they're quacking on the flows. For Nvidia, for example. And again, I didn't own that, unfortunately, but if I did, I would be a seller. I would be reducing my position into that unusual strength yesterday. All right. So hopefully this made sense. I didn't really prepare much on this, and I think it showed a little bit. But I thought about, what Charles said yesterday. I listened to his podcast, and I really thought long and hard afterwards about, how am I going to do that? How am I going to have something like that potentially? And it might not be the first try. It might take me 2 or 3 or 4 tries before you get that one right. But that's my objective. So I appreciate it, guys. Thank you as always. Here's our contact information. Reach us at marcussmith.com, 800-831-2525. The podcast, if you have like Apple on your phone, podcasts, it's the IBD podcast, and you can find it on investors.com's website. They have a tab called videos, I believe, and under videos are the podcasts, and you can check out Charles from yesterday. All right, everybody. Thanks a lot. Have a great day. Bye-bye.